That's the positive side of hyperinflation. It stops people from killing each other eventually because they run out of money to do so. It's, a morbid.
You're watching Silver News Daily. Subscribe for more.
Did you know that silver could skyrocket by 300% in the next year due to a massive short squeeze? Sounds unbelievable, right? But stay with me, because what's coming in the remainder of 2024 could change everything you thought you knew about the silver market. Rafi Faber, a well-known expert, has issued a stark warning, one that every silver stacker and investor needs to gear. In today's video, we're diving deep into why silver prices might be on the verge of exploding, driven by a perfect storm of skyrocketing demand and an impending supply crunch. Trust me, you don't want to miss what's coming next.
At the Fed, the St. Louis Fed has these charts, right? It's called Fred. So if you Google Fred SOFR volume, right, you'll see that this is the amount of reserves that are trading between banks every night. And since 2021, I believe, early 2021, they've gone up and up and up and up. And they went from like less than $1 trillion to now 2.1, 2.2 trillion last night, a new record. And almost every night there's a new record. It kind of zigzags, but it zigzags up. So I think right now they're right near 2.2 trillion. But like these are not, it's not the fountain of youth. It's not an everlasting gobstopper. I mean, they're taking these reserves from somewhere. They're taking it from their reserve balances, right? Which you can see on it's the other side of the dead debt again. That's that's on the Fed's balance sheet. And once the reason you can never get rid of it is that, let's say a mortgage-backed security that the Fed bought in 2008, right? Now it's 2023. Let's say they bought it in 2008 and it had 15, 16 years maturity until it was matured. So now all that money's owed back to the Fed. So the Fed gets the dollars from the banking system. Whoever pays it doesn't make a difference, right? And then that money goes away back into the Fed, into the black hole of the Fed. And then there's fewer reserves in the system, but if there's fewer reserves in the system and the SOFR volume, the repo volume keeps going up, well, eventually you're going to hit something where you don't have enough dollars to satisfy all the daily repos that are happening every night. And then what happens then? We know what happens then. What happens then is that overnight interest rates go up to 10%. And everyone's like, oh my gosh, we have to print again. So that's going to happen. Exactly when, I don't know what's going to happen. But the last time, I have a heuristic that might work out. Again, like this is not anyone has a doctorate in, so nobody really knows. But when the repocalypse hit, I did the calculations, and what we saw was that repos were taking up 87% of the available bank reserves, of the available ghost of dead debt. So my theory is that once we hit 87% or somewhere around there, it could be less, could be a little bit more, something like that, then there's going to be another problem in the plumbing, and the Fed's going to have to print the missing reserves and buy something else, buy some more crap dead debt. the next marginally dead debt it's going to have to buy. The question is how much damage is going to be done before they can pull that trigger again. And I don't know. So right now we're at about 66%. So when we get to 86, 87%, it could trigger it, and that could be in a matter of months.
As we look ahead to the remainder of 2024, the silver market is setting the stage for what could be a monumental shift. The forces at play are unlike anything we've seen in recent years. On one side, we have an unprecedented surge in demand, driven not just by retail investors, but by the industrial sector, even the military. And on the other, a looming shortage of silver that could spark a chain reaction in the market. Let's start with the numbers. The renewable energy sector, particularly solar power, is experiencing a boom like never before. The global shift towards clean energy has driven massive investments in solar panels, where silver is a key component. According to a recent market analysis, the solar panel market alone is expected to grow by over $53 billion by 2028, with a significant portion of this growth happening in Asia-Pacific regions like China, South Korea, and Japan. Silver's role in this industry cannot be overstated. It's used in photovoltaic cells, the heart of solar panels, making it an indispensable resource. But it doesn't stop there. The military's increasing reliance on advanced technologies, many of which require silver for their electronic and defense systems, adds another layer of demand. And let's not forget the retail market. Individual investors who have long trusted silver as a hedge against economic instability are now doubling down, further tightening the supply. All these factors are converging to create what could be the perfect storm for a silver short squeeze. The demand is rising exponentially, and the supply chain is already showing signs of strain. This isn't just another market fluctuation. This is a brewing storm that could redefine the silver market in 2024.
Yeah, you could even say it's a front door bailout. Why back door? It was so obvious. I mean, it was less obvious to us in 2008, but now we know how it works. It's like it was never as blatant as it was in 2008. It got even more blatant in 2020. And the interesting thing is like, okay, so if it's the ghost of bad debt, why don't you just erase it? Well, because now you have all these banks dependent on these reserves to close their books every night in the repo market, and repos these overnight loans between banks, really from the big banks to the small banks. So the small banks don't have the cash, and the big banks have all the reserves. They become addicted to it. So if these reserves go below a certain threshold, you have what's called a ripocalypse, which we're all familiar with from 2019. So the ghosts in the system have to stay in the system or the system crashes. And so really there is no way of getting rid of all this debt. You have to keep the ghost of it on the balance sheet, or else everything falls over. You know what? Eventually everything is going to fall over, either officially because the Fed's going to say, no, we're not doing it anymore, which is not going to happen, or the public is going to say, look, all those reserves in your banking system, I don't want them anymore. Give me real money. So that once that happens quickly. It hasn't happened yet, but with the world as unstable and scary as it is right now, it could happen pretty quickly once confidence is lost.
As we delve deeper into the silver market, it's clear that the surge in demand isn't just a passing trend. It's a critical shift that could have long-lasting impacts. Rafi Faber has been vocal about the potential for silver to become the commodity of choice, not just for investors, but also for key industries. And when you look at the data, it's hard to argue against him. Let's talk about the retail investors first. Over the past year, there has been a noticeable increase in silver stacking. Individuals buying and holding physical silver as a safeguard against economic uncertainty. This trend isn't just about hedging against inflation. It's about anticipating a market where silver becomes scarce and consequently much more valuable. Faber has pointed out that this behavior is reflective of a growing distrust in traditional financial markets. People are looking for tangible assets, and silver is shining brightly in that regard. But it's not just the average investor who sees the value in silver. The industrial demand for silver is also skyrocketing, particularly in the electronics and renewable energy sectors. The ongoing boom in solar panel production, as mentioned before, plays a significant role in this. However, silver's utility extends beyond that. It's a critical component in everything from electric vehicles to high-tech gadgets. According to Faber, this industrial demand is often underestimated by the market. But it's this very underestimation that could lead to a dramatic price correction when the reality of the shortage sets in. Faber's take on this is particularly insightful. He suggests that the market is yet to fully price in the impact of the industrial demand on silver's future value. He warns that as industries continue to ramp up production to meet global demand, they'll increasingly compete with retail investors for the same limited silver supply. This competition, he argues, could be the trigger for the short squeeze, as supply fails to keep pace with the relentless demand. In essence, we are seeing a dual-front demand surge. Retail investors hoarding silver for its safe haven appeal, and industries consuming it for its irreplaceable utility. Together, these forces are tightening the noose on silver's availability, pushing us closer to the tipping point that Faber and other experts have been warning about.
In a few weeks at the beginning of the 2008 financial crisis. And at the same time, reserves went from just a couple billion, I don't know, was it 10 billion like that, to about 800 billion reserves. So what actually happened was that all this debt couldn't be paid at the same time, whether it was commercial paper, long-term debt, short-term, everything was just dominoing into the next thing. So nothing could be paid. So what the Fed offered to do was said, all that bad debt that can't be paid, look, we'll pay for it and we'll give you reserves. So the banks ended up holding on to these reserves, and all that garbage is on the Fed's balance sheet. And now from about 2008 to 2020, the Fed called this stuff excess reserves because they're supposed to keep a certain amount of reserve on the system, right? To pay emergencies or for recessions and withdrawals and stuff like that. But now they had excess reserves. So then in 2020, they stopped calling it excess reserves because it got just too out of hand. Because in 2020, they printed another 3 trillion of this stuff, but all that other debt couldn't be paid because they had frozen the entire economy for reasons that we all know why, and we won't get into. So that debt couldn't be paid, and all of a sudden reserves are like wham, because they said we'll take all that stuff and we'll give you just dollars, and you'll keep it on your balance sheet. So all the dead debt that could never be paid back is still there. It's just in the form of something called reserves. And what do the banks do with this stuff? And from here, I guess we'll segue into the next question. What do they do with it? They trade it between each other. It's not like every bank has these. Very few banks have any excess reserves. It's the very big banks like JP Morgan and Bank of America, and what's the other one? I don't know, Wells Fargo. What are the big ones? They're the ones that have the excess. And the other regional banks, the smaller banks, don't have any excess. So they have to borrow from the repo market. And the other excess goes to doing repo loans for emergency, closing their books with regulatory standards. So the big banks are earning a lot of interest on these repo loans that they use reserves to make extra money on. And they don't really go into the economy. They're just shuffled between banks. That's it.
While retail and industrial demands are putting significant pressure on the silver market, there's another player in the game that could tip the scales even further: the military. Silver's strategic importance in defense and advanced technologies cannot be overstated, and according to Rafi Faber, this is an aspect that the market often overlooks until it's too late. Let's break this down. The modern military relies heavily on advanced electronics and communication systems, many of which require silver for their critical components. From guidance systems in missiles to sophisticated radar technology, silver is a non-negotiable resource. As global tensions rise and defense budgets expand, the demand for these technologies, and by extension silver, continues to grow. Faber has noted that this isn't just about current military operations. It's about strategic stockpiling. Governments are increasingly aware of silver's vital role in national security, and this has led to a quiet but significant accumulation of the metal. This kind of demand isn't subject to the usual market forces of supply and demand. It's driven by the need for preparedness, which means it can spike suddenly and without warning. What's particularly concerning, as Faber points out, is that this strategic demand operates in the shadows, often going unnoticed until it begins to impact the market visibly. By the time the public realizes the extent of this demand, it may already be too late for prices to remain stable. The combination of industrial, retail, and now military demand creates a perfect scenario for a supply crunch. In Faber's view, the military's growing appetite for silver is a crucial factor that could accelerate the impending short squeeze. As more silver is diverted into strategic reserves in military applications, less is available for other sectors. This tightening of supply, coupled with rising demand from all sides, is what could propel silver prices to unprecedented levels, catching many by surprise. The message here is clear. Silver is not just a commodity, it's a strategic asset. And as governments and military organizations continue to secure their share, the pressure on the silver market will only intensify, bringing us one step closer to the scenario Faber has been warning about.
Oh, there's going to be a big Middle East war. Let's buy gold now. You can get caught doing that. I'm not trying to discourage anyone from stacking. Stacking has nothing to do with this because premiums balance out the spot prices all the time. So if you want to add, if you're planning to add to your stacks, don't let don't let the war stop you, or don't let high prices stop you, because once you have it, you're not really going to trade it that much, probably. But if you're trading, I'm not so bullish on the very short term on gold and silver right now. I've seen this before when, Iran threatens and says it's going to bomb Israel, and then they make a show and nothing happens. That's what I think is going to happen this time again. For good or for bad, whatever you think about it. There's like 12 US ships already on the way over here that are just there to calm things down. I don't think they're going to take any action. Hopefully they won't. And the reason that, at least technically, that I'm not so bullish in the immediate sense, meaning just like in weeks, maybe a month, about gold, is that open interest is still very high, meaning there's still a lot of longs and shorts. Each contract is a long and a short, so it's the same number. It's something like 510,000 contracts, and I think we got to get down to like 450,000, something like that, which is pretty low over the last 2 years, in order to start a new rally. And I think this whole war talk is a lot of hype. Or maybe I'm just hopeful because I don't really want to be in a war or get evacuated right now, wherever. So I'm trying to stay positive, and I want to see gold calm down here, which, again, on the back end would calm down the war rhetoric. And once we get down to 450, I think we'll head for another leg up, maybe to 2700. Who knows how long or short, but that's all that is. It's peanuts, because one day the dollar's not going to work anymore and gold's going to move to, like, I don't know, 3,000 to 20,000 in a week, something like that. I'm not saying that's going to be the number is going to be a week. I'm saying something like that is going to happen at some point, and by then it'll be too late. You don't want to play with fire like that.
As the demand for silver continues to rise across various sectors, a looming threat is emerging that could drastically alter the market landscape: the short seller's trap. This scenario, which Rafi Faber has been particularly vocal about, is where the real fireworks could begin. To understand the potential impact, we need to revisit the concept of short selling. Short sellers bet against the price of silver, hoping it will drop so they can buy back at a lower price and pocket the difference. However, what happens when the market moves in the opposite direction? That's where the short squeeze comes into play, a situation where short sellers are forced to buy back their positions at increasingly higher prices, creating a self-reinforcing cycle of rising prices. Faber has drawn parallels between what could happen in the silver market and past events like the GameStop saga, where retail investors orchestrated a massive short squeeze, causing the stock price to soar. But unlike a single stock, silver is a globally traded commodity with far-reaching implications. A short squeeze here wouldn't just affect a group of hedge funds. It could send shockwaves throughout the financial system. What makes silver particularly vulnerable, according to Faber, is the disconnect between paper silver, futures contracts, and physical silver. Many traders deal in paper silver without ever intending to take delivery of the actual metal. This works fine as long as everyone plays along. But if demand for physical silver spikes, as it is now, those holding paper contracts might suddenly find themselves unable to cover their positions, triggering a rush to secure physical silver at any cost. This scenario, Faber warns, is not just a theoretical risk, it's a very real possibility as we move further into 2024. With increasing demand from industrial, military, and retail sectors, the available supply of physical silver is dwindling. If short sellers are caught in this trap, they will be forced to cover their positions in a market where silver is becoming increasingly scarce, driving prices even higher in the process. Faber's take is clear. The silver market is a ticking time bomb for short sellers. The combination of a supply squeeze and rising demand across multiple sectors could ignite a short squeeze of historic proportions. And when that happens, those who are short on silver may find themselves in an inescapable trap, further fueling the surge in prices.
Hiccup is going to be an earthquake, or just going to be a little cough. Like 2023 was a cough. and we thought maybe it was going to be the thing, maybe it was going to be the big one, but it wasn't. In 2020, I knew it was going to be big. I wasn't sure if it was going to be the last thing. But I'm getting a feeling that maybe it's because I'm on the front lines of this thing on the Lebanese border, that things are starting to get out of hand, at least geopolitically. And that's the front end of the rotting monetary system. The monetary system is the back end of what's going on politically. It always happens that way. So uh you know I don't the way that things are going on, and on the sort of corollary to that is that the most of the countries that are involved in the big conflicts like Lebanon, Iran, Syria, none of them have functional currencies. None of them. They all use the dollar because their currencies have already hyperinflated to nothing. So hyperinflation is part of all of this stuff, and that's what's driving all these countries crazy. So I just see the front end and the back end coming together sometime soon, and hopefully saving us from annihilation. That would be nice. I'm not the kind of guy that believes that we're going to annihilate ourselves. I'm much more positive than that, but that's the positive side of hyperinflation. It stops people from killing each other eventually because they run out of money to do so. It's,
As we continue to explore the various forces driving the silver market, it's impossible to ignore the critical role that silver plays in the booming solar panel industry. Rafi Faber has emphasized time and again that this sector is one of the most underappreciated drivers of silver demand, yet it holds the potential to significantly impact the market in the coming years. The global push towards renewable energy has put solar power at the forefront of the clean energy revolution. Solar panels, which are essential for converting sunlight into electricity, rely heavily on silver. Each photovoltaic (PV) cell within a solar panel requires a small but vital amount of silver to function. As more countries commit to reducing their carbon footprints and transitioning to green energy, the demand for solar panels is skyrocketing. According to market forecasts, the solar panel industry is expected to grow by over $53 billion between 2024 and 2028. This growth isn't confined to a single region. It's a global phenomenon with significant expansion in Asia-Pacific, Europe, and North America. But here's where things get interesting. The amount of silver needed for solar panel production is substantial, and as the industry scales up, so does its consumption of silver. Faber points out that this increasing demand from the solar sector could be the tipping point that exacerbates the already tight supply situation in the silver market. The solar industry's need for silver is relentless, and as more panels are produced to meet global energy needs, the strain on silver supplies will only intensify. This isn't just a future concern. It's happening now, and its effects are beginning to ripple through the market. But it's not just about the quantity of silver needed. Faber also highlights the technological advancements in the solar industry that could further boost silver demand. Innovations like floating solar panels and transparent PV cells, which are gaining traction, also rely on silver. These advancements are driving new applications and expanding the market, making silver an even more indispensable component of our energy future. The bottom line is this: as the world shifts towards renewable energy, silver's role in the solar industry ensures that demand will remain strong for years to come. And with the current pressures on silver supply, this could lead to significant price increases as industries compete for limited resources. Faber's perspective suggests that those who recognize the strategic importance of silver in the solar sector will be better positioned to navigate the market's future volatility.
As an everyday average guy, is that one of these crashes or one of these crises is going to spur a much larger avalanche in debt that the Fed is going to have to print much, much, much more. So, we saw in the regional banking crisis, it didn't really affect anyone unless you were a shareholder of Silicon Valley Bank, because the Fed was able to assure everyone that they didn't have to take all their money out and they were going to bail everything out. And the the QE that they embarked on, it was only a few $100 billion. Only a few $100 billion is the numbers that we're used to saying these days. But so I mean, it could be another one of those, but I don't think so. I don't think it's going to be, and I think it's going to be much bigger, like 2020, but times 2 or 3, right? Because 2020 was times 2 or 3. 2008 was much more times 2 or 3 than 2001. It keeps going in that direction. So if you're an average guy or gal, what I would be watching for is if the Fed has to print, let's say 7, 8, 9 trillion in reserves in a week, then you could really start to see a panic in the dollar, and you'll need your physical gold and silver and your food for like a month or two, or however long it's going to take for things to calm down. You don't want to be in bread lines. So just watch out for that. If it's going to be another size, 2020 in size, then you probably got a few weeks to a few months to get your monetary affairs in order.
As we've seen, the demand for silver is surging across multiple sectors, from retail investors and industrial users to the military and renewable energy industries. But what happens when this soaring demand collides with an increasingly fragile supply chain? According to Rafi Faber, this is where the silver market's vulnerabilities become most apparent, and it's a scenario that could lead to a significant disruption in the market. The global silver supply chain is complex and at times precarious. Silver is primarily extracted as a byproduct of mining for other metals like copper, lead, and zinc, which means its availability is closely tied to the production rates of these base metals. When mining operations slowed down due to economic downturns, environmental regulations, or geopolitical instability, silver production can be severely impacted. Faber has warned that the world is already seeing the early signs of such disruptions. For instance, key silver-producing regions are facing challenges such as stricter environmental policies and labor strikes, which have historically led to reduced output. Furthermore, as the easier-to-mine silver deposits are depleted, extraction becomes more difficult and costly, further straining the supply. Another critical issue is the refining and transportation of silver. As the demand for silver spikes, any bottlenecks in refining capacity or logistics can create significant delays, making it harder for the market to respond quickly to rising demand. Faber points out that during the COVID-19 pandemic, we saw how vulnerable supply chains could be, with delays and shortages becoming commonplace. Although the world has largely moved past the immediate crisis, the silver market remains susceptible to similar disruptions. Moreover, geopolitical tensions can also play a role in supply chain disruptions. Countries that control significant silver resources may use them as a bargaining chip in international negotiations, or could face sanctions that limit their ability to export silver. These factors add another layer of uncertainty to an already strained supply chain. Faber believes that these pressures are not just temporary hiccups, they are indicative of deeper systemic issues within the silver market. As the supply chain becomes more stressed, the market could face a tipping point where the available silver simply cannot meet the demand, leading to sharp price increases. In summary, the supply chain pressures surrounding silver are an often overlooked factor that could have a dramatic impact on the market. As demand continues to rise and supply struggles to keep up, Faber warns that we could be heading towards a critical juncture where silver becomes increasingly scarce and valuable. The question isn't if these pressures will impact the market, but when and how severely.
Similar to reserves, not exactly the same. So the monetary base, it shrinks as quantitative tightening continues, and quantitative tightening is continuing. It's continuing at a slower pace. That's basically when the Fed has interest-bearing assets on its balance sheet, and so when whoever owes the money, whether it's a mortgage or a treasury, pays that security, the money goes ultimately to the Fed, and then it goes out of existence and the monetary base shrinks. The monetary base is the base of the dollar pyramid upon which all other debt is built. So when you hear people say that every dollar that exists is ultimately owed back to the Fed, well, that's what they mean. Because how are these dollars brought into existence? They're brought into existence as the Fed buys the debt and then hands out the dollars to the banking system. And so ultimately, whoever's spending it, it shuffles around and goes from party to party to party until ultimately somebody has to pay back the debt that the Fed ultimately bought, and then the monetary base shrinks. So as the base shrinks, the reserves will shrink. As the reserves will shrink, we get closer and closer to some kind of not inflection point, but contact point. Say crash. I forgot my English, but you know what I'm saying. And it's going to come. It's going to come, I think, somewhere around $3 trillion because that's where the regional banking crisis hit. So 3 trillion, we're at 3.27 right now, and it zigs up and down, and the trend has been down for about 5 months now.
As we approach the critical point where supply struggles to meet demand, the silver market stands on the brink of what could be a full-blown crisis. Rafi Faber has been among the leading voices sounding the alarm on this impending scenario, warning that the silver market's current trajectory could lead to unprecedented price spikes and severe shortages. The term silver crisis might sound dramatic, but when you break down the factors at play, it becomes clear that this is not an exaggeration. We've already discussed the various sectors driving demand: retail investors hoarding silver as a hedge, industries like electronics and solar energy consuming massive amounts, and the military stockpiling for strategic purposes. Meanwhile, the supply chain is showing signs of significant strain, unable to keep pace with the escalating demand. Faber points out that this crisis isn't just about the immediate scarcity of silver, it's about the market's inability to respond effectively. Unlike other commodities, where production can be ramped up relatively quickly to meet demand, silver is limited by its reliance on the mining of other base metals and the lengthy, complex processes involved in refining and transportation. When these processes falter, the ripple effects are felt across the entire market. Adding fuel to the fire is the potential for a massive short squeeze, as we've previously discussed. If short sellers are caught in a bind, unable to cover their positions due to a lack of available silver, prices could skyrocket in a matter of days. Faber emphasizes that this could create a feedback loop. Rising prices trigger more panic buying, which in turn drives prices even higher. The economic ramifications of such a crisis could be far-reaching. For one, industries that depend on silver could face production halts or be forced to pay exorbitant prices to secure the metal, leading to higher costs for consumers. Additionally, the financial markets could experience significant volatility as investors scramble to adjust their portfolios in response to rapidly changing silver prices. Faber's assessment is that this crisis could unfold sooner rather than later, especially given the current market dynamics. He argues that the silver market is dangerously close to a tipping point where even a minor disruption, such as a significant geopolitical event, a new wave of industrial demand, or a sudden increase in investor interest, could trigger a chain reaction. The implications are clear. Those who are not prepared for this potential crisis could find themselves at a severe disadvantage. Whether you're an investor, a manufacturer, or simply someone interested in the economic landscape, understanding the forces driving the silver market is crucial. Faber's warning is stark but necessary. This is a crisis that could reshape the silver market for years to come, and it's one that demands our attention now, as we inch closer to what Rafi Faber and many other experts believe to be an inevitable silver crisis. The question on everyone's mind is, when will the spike happen? The conditions are all in place: surging demand, constrained supply, and the looming threat of a short squeeze. It's not a matter of if the price of silver will skyrocket, but when. Faber has been clear in his assessment. The silver market is a powder keg waiting for a spark. The ongoing pressures from the industrial, military, and investment sectors have created a scenario where any additional strain could trigger an explosive price increase. The silver market is notoriously volatile, But what we're looking at now is a potential perfect storm that could push prices to levels we haven't seen before. This inevitable spike will likely be driven by a convergence of factors. Firstly, the industrial demand, especially from the solar industry, continues to grow unabated. As we've discussed, silver is irreplaceable in photovoltaic technology, and with global energy policies increasingly favoring renewable sources, the demand for silver in this sector alone is enough to stretch supplies thin. Secondly, retail investors are increasingly viewing silver as a safe haven asset. In times of economic uncertainty, the flight to tangible assets like silver intensifies, further tightening the market. Faber points out that this trend is gaining momentum as more investors seek to protect their wealth from inflation and potential market downturns. The third and perhaps most unpredictable factor is the financial market dynamics surrounding silver. The potential for a short squeeze looms large. If short sellers are forced to cover their positions in a market where silver is already in short supply, the resulting price spike could be dramatic and swift. Fager likens this to a domino effect. Once the first few pieces fall, the entire market could be propelled into a buying frenzy. Faber's view is that this spike could happen almost overnight. One day, silver could be trading at what seems like a stable price, and next, a combination of geopolitical events, sudden industrial demand, or a surge in retail buying could send prices soaring. For those who are prepared, this could represent a significant financial opportunity. But for those caught off guard, the rapid rise in prices could be a harsh wake-up call. In summary, the silver market is primed for a significant price increase. The conditions are ripe, and all it takes is a single catalyst to set off the chain reaction. Faber's insights suggest that we are closer to this spike than many realize, and those who take action now could stand to benefit the most when the market finally reacts.